Okay, we're going to get started. Welcome to Market News International's April webinar on the Eurozone sovereign debt crisis. I'm Lauren Hand. I'm the marketing manager here at M&I. And today, I am going to explain a little bit about M&I, give you a brief overview. Then Nick Shamim is going to lead our discussion for about 15 to 20 minutes. That will be followed by a Q&A session. At any time during the presentation, if you have a question, you can enter in the chat box or the Q&A box. If you enter it in the chat box, you can direct your question to me or you can direct it to Nick. We will try to get to all of the questions at the end during the Q&A session, time permitting, of course. So, with that, a little bit about M&I. Market News International is a subsidiary of the Deutsche Börse Group and the leading provider of news and analysis specific to the global FX and fixed income markets. We have 4 real-time English language financial news agencies with press credentials recognized by governments and central banks of all major economies. We offer exclusive monetary and fiscal policy reports, economic indicators and forecasts, and market-moving interviews with key central bank and finance ministry officials, government policymakers, and economists. Our 60 full-time journalists are located in 12 news bureaus across Europe, America, and Asia, many of which are former fixed income and currency traders and strategists who know the markets and combine their economics expertise with meticulous financial journalism. And today's featured reporter is Nick Shamim. Is our fixed income managing analyst and manager of M&I fixed income bullet points and M&I foreign exchange bullet points in Europe. Nick, in 2001, he produced a very successful morning fixed income email service and frequently contributes to the M&I Mainwire product on regular Eurozone bond auction analysis and Eurozone funding exclusives. He is a qualified technical analyst and certified financial technician and holds a Bachelor of Science in Economics and a Master of Science in International Banking and Finance. During today's webinar, Nick will give an update on the status of each EMU borrower and analyze the chances of contagion to Italy and Spain as the last of the peripheral countries likely to risk requiring EU funding. And with that, I will pass the presenter role over to Nick.
Lauren, for that kind introduction. As Lauren said, I am Nick Shamim, and today, basically, we're going to go through a few bits on the Eurozone sovereign debt crisis. We're going to go through like a brief history of the bailouts we've had so far, look at which country could be vulnerable next as the next domino to fall, look at for and against this country being out, that Italy is also vulnerable, and then basically a conclusion whether Spain is too big to fail or whether it's too big to bail. So start off as a quick history of the bailout so far. Firstly, we had Greece. Greece was bailed out May 2nd, 2010, where the basically Eurozone and the IMF agreed to lend Greece up to about 110 billion euros over 3 years. Out of 110 billion, 80 billion was bilateral loans from its 15 Eurozone partners, and the remaining 30 billion as a standby facility from the IMF. The whole deal assumed that Greece would be out of the markets for a maximum 18 months, i.e. to the end of 2011. At the time, Greece was then set to borrow at around 5% interest rate. However, since then, the rules have changed a bit. The EU Leaders Summit in mid-March, the interest rate on its bilateral loans to Greece were lowered by around 100 basis points, i.e. Euribor mid-swaps 200 basis points up to 3 years, and Euribor mid-swaps 300 basis points beyond. And also maturity of loans were extended to 2.5 years, pretty much in line with the IMF terms. And then since mid-March, the markets are now sort of pricing in further debt restructuring, but we'll take a look at this later in the webinar. And now, moving on to Ireland, up to the inevitable on late Sunday, November 1st, 2010, when it said it was applying for aid from the EU and IMF. This weekend, the EU FinMins had approved an 85 billion support plan for Ireland, And at the time, that basically soothed market concerns on contagion spreading to other peripheral countries. Under the deal, the EU and IMF will provide loans worth 67.5 billion, and Ireland kindly said they'll put up 17.5 billion of its own money, gathered from the National Pension Fund. At what rate will Ireland borrow? Basically, close to around 6% is what Olli Rehn, the EU Commissioner for Economic and Monetary Affairs, said at the time. The timing of this bailout was pretty odd, as Ireland had already completed its 2010 issuance programme. They sold pretty much just over 2 billion worth of bonds out of its 20 billion target. It meant that Ireland was already pre-funding for 2011. Ireland also had a sizable chunk in its exchequer account, and it also had an impressive cash reserve in its pension funds. So, in this next part, you can see basically bailed out. The white line here, around the 7% level, is the sort of key marker. It's Greece basically breached before it sort of requested aid, and again you can see Ireland, which is the orange line, had breached that level, and a few weeks later it had basically requested aid. So the winner was Portugal. Basically, sort of applied on April 6, 2011, which is not the usual Sunday, but then the outgoing Prime Minister, Socrates, announced that his caretaker government had decided to request aid from the EU bailout fund. He submitted his resignation 2 weeks ago and basically said that Portugal had negotiated an aid package out of its national interest, as the country's rapidly deteriorating financial situation would have aggravated it if they had done nothing. The request for aid came at a time when Portugal had a huge redemption coupon payment in April and June, which totaled 12 billion. At the time, M&I did a sort of quick back-of-the-envelope calculation and found with its extraordinary tap it did of 2012 OT issue on the Friday before it requested aid, and with the TL sales and private placement deals, which was also quite strong, it managed to bolster its cash position to about 7.5 billion euros. And at the time, it was actually helping sort of alleviate market fears that Portugal could meet its bond redemption for April, which was 5.05 billion. But there were worries whether it had enough funds to meet its June payment of 6.95 billion. I think also what broke the camel's back at the time was when the debt agency, the IGCP, sold 6-month and 12-month T-bills at a very much higher rate compared to its previous auction. As a recap, I won't bore everyone. The IGCP sold 6-month T-bills at a rate of 5.117, bid to cover 2.3. This compares to its previous sale earlier at an average rate of 2.985. That's a staggering 213 basis points more expensive. The 12-month T-bill was sold at 5.902%, bid to cover 2.6. And that compares to the previous average yield rate of 4.331, i.e. 157 basis points more expensive. At the time, there were plenty of reports that France and Germany are putting pressure on Portugal to access the rescue fund in order to prevent the crisis from spreading to other countries. Portugal was then sort of treading back to its chin again. It was teetering above the 7% threshold level, which was making its debt pretty much unsustainable. Overall, the markets estimate the size of the Portuguese bailout at around between 70 to 90 billion. Now, the question is, who is next? Which country is the next likely domino to fall? The country that's been bid around is Spain. If I just run through a few sort of interesting factoids, which you probably already know, Spain is Eurozone's fourth largest economy. It's the 10th largest economy in the world. Twice as large as the troubled trio of Greece, Ireland, and Portugal. Spain accounts for about 11.5% of Eurozone GDP, and that compares to Greece's 2.5%. So basically, Spain's the 800-pound gorilla, and the markets basically do think at this stage that it is too big to fail. Thinking this. Write down of the main points. The main one, as the economist points out, the unemployment rate is at 20.5%. It's the highest in Europe. Out of that, youth unemployment is a staggering sort of 40%. Real disposable income is declining. It's at its fastest record since records began in 1970. It has pretty grim growth prospects. Spain dragged itself out of an 18-month recession at the start of last year, but growth has since then sort of stuttered. The Central Bank itself, the Bank of Spain, and many other economists doubt the economy grows as much as what the government expects. The government is projecting growth of 1.3% a year, has recently lowered growth estimates for 2012 to 2.5% from 2.3% from 2.5%, and also its 2013 growth from 2.7% to 2.4%, due to the impact of high interest rates on oil prices. The Spain predicts the economy will grow by just 0.7% and 1.5% in 2012. There are some economists out there who are sort of predicting growth of between 0.6% to 1.2% in years ahead. 50 group economists are forecasting close to zero growth. Stunt growth will make it very difficult for Spain to reduce its deficit, and as we know, these prophecies basically, once they start, they sort of snowball. What others can we think of? Back. ECB is normalizing its interest rates. The ECB recently put up its interest rates on April 7th, and the Ionia curve is implying a higher rate trajectory, and pricing in rates of around 2% by May 2012. Higher European rates are basically going to push up the Spanish 10-year yield spread, and basically breaks that 7% threshold level, which I pointed out earlier. This will make its debt servicing unsustainable, and unfortunately may trigger the bailouts. Another reason, the Spanish housing market still looking for vulnerable. There are about 1 million unsold homes in the market in Spain. Interest rates in Europe will put pressure on Spain, where many of the mortgage homeowners on variable interest rate deals. The ECB's interest rate increases will raise the monthly mortgage payments, which are already been hit by higher food prices and higher inflation in general. And the reason we look at is the Spanish banking sector. Spain's banks have estimated exposure of around 65 billion to Portugal, the largest of any Eurozone country, twice exposure of Germany and France. And with prices falling and default rates set to go up, the already undercapitalized banks will need about 20 billion to offset some write-downs, according to government numbers. Moody, on the other hand, the cost will be nearer to 40 to 50 billion. So the government is expecting. As you can see on the slide, estimates the extra capital to be about 38 billion. So there are some sort of question marks whether Spanish banks, whether they can actually meet the Basel III requirements and how much extra money, in particular, creditors will need compared to what the government assumptions are. Number 7, Spain on its issuance program compared to its EMU neighbours is looking like it's well behind. This here is a sheet which M&I produces pretty much every day after each Eurozone country does an auction. So this is a up-to-date figure after today's Dutch, Italian Linker and new German 10-year Bund sale. As you can see from here, the last column, basically Spain here, shows that it's only sold 35.5 billion out of its 93 billion gross fund target. Just under 40% is pretty much languishing toward the bottom end. You compare that to Austria, they're at 45%, Belgium 51%, Finland 56%, at Netherlands at 44%, and Portugal, before it sort of was at 43%. So what is that? This compares the year-to-date issuance, being at 38%, is basically well ahead of this past year issuance at 33%. So it is front-loading, it's doing its best, but it's still way behind compared to its EMU neighbours. Another reason, 8th reason, it does face big redemption payments in the coming months. As I said before, Portugal became vulnerable with its big redemption payments, was due to have. This table here basically shows all the redemptions and coupon payments that are due in the next few months, and these numbers are pretty staggering. It's got a pretty chunky 15.5 billion redemption this week, and coupon for under that 3 billion. The Spanish Treasury has said it's got funds for this already. If you look ahead, it's going to be a pretty busy summer for them to raise that kind of capital to pay some of these redemptions off. That's another reason why the markets will. Another reason, looking at the Spanish deficit numbers, its deficit at 9.2% is much worse than Portugal's. This was recently updated by Eurostat yesterday. This is despite having a lower public debt burden than 60% last year, which compares to Portugal's 93%. I've summarised a table which Eurostat released yesterday. It shows Ireland pretty much at the top there. Its deficit is standing at 32.4% of GDP. And you can also see that some of the other countries like France and Italy and Belarus are pretty high as well. So EMU had a cut-off point of 3% under its market criteria, and they're well in breach of that at the moment. So that's the reasons why Spain is vulnerable. At the same time, there are also reasons why the market thinks that Spain will be fine. The measures that have been employed by Zapatero's government so far show that he has front-loaded some of the budget consolidation, and he hasn't balked at bringing down the deficit. He has raised the pension age from 65 to 67. His taxes. He's cut public sector wages. He's trying to reduce some of the structural market rigidities. It was also injected small amounts of money into the weakest banks. Importantly, it hasn't repeated the same mistakes Ireland has made, and that is guaranteeing its bank creditors. Also, slide, the government has room to basically tighten fiscal policy further, further leeway. It could, for instance, adjust its VAT rate. Its VAT rate is currently 18%, and that compares to Ireland at 21%, Greece and Portugal was 23%. Also, the government debt is only domestically at 53%, and that compares to Ireland's 15%, Portugal at 30%. So it can increase its international share. And market media reports have suggested there is a strong interest in foreign investment in Spanish bonds. Although the reports have been a bit mixed, in particular about the Chinese interest, there have been interest from Russia as well. So it is another factor which is there underpinning the Spanish bond market. And basically, I think the market does expect Spain to cut deficit down to 6% GDP this year. If you compare that to the Portugal last austerity measures that were rejected by Parliament, it wasn't looking very likely. Another reason is that the recent bond auctions, the 2021 and the 2024, last Wednesday, was well received. Yesterday's 3-month and 6-month T-bills were also quite well received. Although the yields were higher, the beta ratios are pretty impressive, and managed to sell a decent amount of allocation there. So the situation is very different here. But it's also possible that the market confidence will falter. The situation facing the cadgers is very, very worrying. And if the markets do lose confidence, then it would be much more difficult for bailout to be effective. Moving on to the next slide, is Italy also vulnerable? Yes. If you look at its GDP ratio, which I put up earlier, its debt to GDP is 19%, which is alarming. Italy has strayed away from front-loading its fiscal adjustments and through painful reform. Ratings agencies at the moment are pretty kind to Italy, actually, as you can see on this slide. Italy is rated stable across the 3 major ratings agencies: Fitch at AA-, S&P A+, and Moody's Aa2. But as we know, the ratings agencies are pretty fickle, and as yield spreads sort of widen, as markets lose confidence, Italy could be forced into austerity and unpopular measures, and push the political picture, which is already quite fragile, into a bit of a dangerous territory. However, saying that, at the moment, if you look at the actual chart here, the markets have a pretty relaxed view on Italy. The chart here shows the 10-year yield versus the German benchmark 10-year yield spread. And the green line at the bottom is the Italian 10-year BTP spread, and that's pretty sort of just bumbling at the bottom there, around 150 basis points, well below the high seen during the height of the crisis. And if you compare that to Greece, the white line, it's now sort of trading around 1,200 basis point spread. Portugal and Ireland, again, hitting fresh record highs. This is a chart taken late yesterday, so apologies, it's not up to date, but the general picture you could probably see is spreads are widening in the others, and Italy and Spain at the moment are still pretty immune to any of this. So currently a 10-year spread around 1,500 basis points shows that the market is pretty complainant about Italy, as a next victim. But as our situation can change very quickly, there's stories going around about Greece restructuring. There's no substance to any of these stories as yet. It's pure speculation, but the speculation is driving the yield spreads to record levels and unmanageable levels for Greece to even contemplate coming back to the debt market end of this year. And there's also uncertainty in Finland. The Eurosceptic True Finn Party won its, it did quite well in elections and now makes some sort of potential delay for funds to Portugal. So the now. So the conclusion basically is Spain too big to fail, or is it too big to bail? Well, I think it's a bit of both, really. I think it really is the question whether Spain's next is a very powerful question. Afford to really think in such a way. It won't be just another domino, it will be a dam which will cause devastating effects in the Eurozone. If Spain goes, this will pretty much bust the EFSF's 440 billion bailout pot, and much endanger the entire Euro framework. The cost of rescuing Spain will be hundreds of billions of euros, not tens of millions, as was the case in London and Portugal. And the other question I think markets really need to consider is will France and Germany still be rated AAA? And the answer probably is no. Also, do you think Merkel and Sarkozy will ask voters to fund the Spanish bailout? And at the moment, the attention is pretty much on US after S&P recently put its ratings on negative outlook. So the question is whether some of these countries can hold on to their AAA rating, or whether Spain basically be the next one to go. And the markets are keeping faith with Madrid in its efforts in cutting its deficit and continuing with its structural reforms in the labour market. But there are still problems surrounding Greece and other peripheral countries. They've had deficit figures last year revised higher, as I went through here, and growth is still looking a bit shaky and vulnerable as ECB normalises its interest rates. And this is set to get worse. Greece restructure its debt, and will the other two bailed out countries follow suit in restructuring? As I said, the market is pretty relaxed about Spain at the moment. 10-year yields is currently about 5.5%. The 10-year spread is around 220 basis points. So basically, that's the market's literally thinking that Spain will be okay on hope that the EU and ECB officials won't repeat mistakes of the past and make this into another Lehman. However, we know that market prophecies can become self-fulfilling, and the agencies are very fickle, so the situation can change very quickly. So in the meantime, Spain has to go through pain in order to gain. And pain, my God, that rhymes. Well, on that note, this concludes the webinar, and thank you very much for listening.
Thank you very much, Nick. Thanks. And we received a few questions. Unfortunately, we only have time for one quick question, and I'm just going to read the first one that I have. Anyone who wants to ask Nick questions after the webinar is certainly welcome to contact him. I'll have all of our contact information on one of the next slides. So the that I have is, what form of debt restructuring do you expect Greece to do when?
Tricky question. I think the last basically speculated on this. I think the Greek officials have put Interpol on them. So I don't know into speculation here, but what the talking market is there's 5 different sort of scenarios. Firstly, a haircut of between 40 to 50%, which is required to make Greece's debt sustainable. A possible voluntary extension of bond maturities. However, both those methods are pretty costly. Last summer's stress test showed Hypo Real Estate and BNP and SOC have the largest exposure to Greece, and any haircut is likely to put these to a further strain on their capital adequacy ratios ahead of the next stress test. Another plausible scenario is more sort of fiscal assistance from the IMF for the EU, possible EU Brady bond, and also maybe a Greek bond backs in the secondary market by the EFSF or some other EU entity. So those are pretty much sort of like scenarios there. At the moment, it's all pure speculation. There's nothing concrete in any of this. It's all been dialed by the Greek authorities, by the EU. As we know, when yield spreads are at these ridiculous levels, and when its 2-year yield is only 5% and above and rising, it is sustainable. So restructuring does look pretty inevitable.
Okay, thank you very much, Nick.
Thank you, everyone, for listening.
Our next webinar will cover recent developments in the FX market on Monday, May 16th at 4 p.m. Eastern Time. The webinar will be presented by our New York Deputy Bureau Chief Dennis Pettit, who will explain recent price action in the euro and the yen. When you end your webinar session today, you'll be immediately directed to the registration page, or you can register later by visiting marketnews.webex.com. And as promised, here's our contact information. If you have any questions about the content of today's presentation, you can contact Nick at nshamim@marketnews.com, and you can contact me with any questions that I can certainly pass along to Nick. Or if you'd like a recording of today's webinar or a copy of the slides used in today's presentation, my email is lhand@marketnews.com. I also have our sales numbers there, and you can follow us on Twitter at M&I Market News or on Facebook at Market News International. And with that, we'll conclude our webinar today. Thank you very much for joining.